All right, good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to our presentation of ETF and stock strategies that outperform the Robo-Advisors. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics, who is known for developing the Chaikin Power Gauge rating. Along with Marc is Carlton Neel, COO of Chaikin Investments. Carlton spent 5 years as a VP at JP Morgan after having worked alongside market guru Dr. Martin Zweig at Zweig Mutual Funds for nearly 20 years. You're welcome to submit your questions throughout this webinar using the Zoom Q&A window, which is available in the upper left-hand corner of your screen. As a reminder, this webinar is being recorded and a copy will be sent to everyone who has registered. To get us started off, here's Marc Chaikin.
Thank you, Joe, and welcome everybody. In this afternoon's webinar, I'm joined, as Joe said, by my partner, Carlton Neel, who runs Chaikin Investments. We got the intro a little backwards. As Carlton will tell you, he started at JP Morgan, and for the last 20 years plus, he's been running the Zweig Mutual Funds, and both open-end and closed-end, and he's now joined Chaikin Analytics. So what you're going to get today is a perspective from me, having built our Chaikin Power Gauge rating, which is our multi-factor quantitative model, and worked with institutional investors over the years, and from Carlton, who's actually consumed models as a portfolio manager and brings hands-on portfolio management experience to the portfolio construction problem that we all face. So we're going to talk about ETFs and stock strategies, and we've got a little catchy title because Robo-Advisors are on everybody's mind, but I think most of you know that Robo-Advisors may not outlive the next bear market, but they're certainly in the news today. So a tiny bit about my background: 50 years on Wall Street. Started out Series 7 registered, as most of you are. The day the bear market of 1966 ended, and first couple of years of my career, every day was an uptick. And then when I encountered my first bear market, I realized how important it was to have something else to fall back on when fundamental analysis wasn't working. And that's why I started a 45-year odyssey into technical analysis. And many of you who do technical analysis may know the Chaikin Money Flow and volatility bands that we've been using with institutional investors for over 30 years. Along the way, I headed up the options department at a regional firm that many of you know, Tucker Anthony and R.L. Day. So I learned the pitfalls of options trading and why most people lose money in options. But I also learned an important lesson that we're going to share with you in just a minute. Along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were clients, and some of them were colleagues. One of my colleagues was a guy named George Douglas at Drexel Burnham, who pioneered the research into earnings surprise and earnings estimate revisions. And we've just lived through a very volatile second quarter earnings season, particularly the reaction to both positive and negative earnings surprises. And I'm going to share with you what George Douglas taught me, and it's incorporated into the Chaikin Power Gauge rating, which really is the culmination of my life's work, a multi-factor model, primarily fundamental, that helps both high net worth individuals and advisors do a better job of constructing portfolios, monitoring your investments and your clients' investments. So with that, I'd like to turn it over to my partner, Carlton Neel.
Hey, Marc, it's great to be with you on the webinar today. As you mentioned, I am now the Chief Operating Officer of Chaikin Investments. We've been partnered up for, hard to believe, but it's going on close to a year. And I know we'll eventually have a number of investable products that advisors and their clients will be able to invest in directly. But today, I'm very excited to talk about the Chaikin Analytics and the Chaikin Analytic platform, how I use it to manage my own money, and how I think advisors can use the platform to transform their own practices. We have a lot in common, Marc. I know one thing that we also have in common is that I started my career also in the midst of a bear market in 1990. I was at JP Morgan for several years before I really wanted to move to a smaller, more entrepreneurial place, and was fortunate enough to be hired by the legendary investor Martin Zweig. And you knew Marty personally. I know Marc, and Marty had a lot of great insights into the market. I was fortunate to work side by side with Marty for nearly 20 years, building portfolios and managing both open and closed-ended mutual funds. So the bulk of my 27-year career on Wall Street has been as an institutional money manager. So I hope I can impart some of my own wisdom on how I use the Chaikin Power Gauge, the analytic tool, and how it can help advisors so that they can use it in their practice and do a better job at conveying great ideas to their clients.
Thank you, Carlton. And what you're going to learn in this 1-hour webinar is our stock and ETF checklist. And we're going to use certain pieces of the Chaikin Analytics platform, the Power Gauge rating, relative strength, and money flow, plus our screener, and most particularly our sector and industry group rankings that we call our power bars, which enable you to find ETFs, both sector, broad-based, and industry, to allocate client assets, but also to find good ideas. And we'll show you how to do that. And then we're going to end the webinar with a concept that I think is really important: how to play good defense and avoid landmines that destroy portfolios. So I'd like to start off with a question. And the big question these days is, are we about to head into a bear market or the first correction in over 15 months? So with that, I'd like to ask Joe Bacella to put up a poll. And Joe, why don't you read that off?
Yeah, so as Mark just mentioned, simply enough, what is your current view on the market? Maybe just as you simply sit today. Are you bullish? Are you feeling a little uncertain, or are you on the other end of the table? Are you feeling bearish about the market? We'll give you a few more seconds. It looks like half the people have already responded, and I see plenty more votes still trickling through. I'll give it a couple more seconds. All right, we'll leave it there. And here's what everyone responded with.
So this is very interesting. 41% of you are bullish, 48% uncertain, only 11% bearish. I'll just share something with you. We did a webinar with a partner of ours, John Malden, who many of you know. And John, if you read his market letters, as many of you do, has become increasingly cautious on the market. So when we took this poll with primarily John Malden subscribers, many of whom are professionals, some of whom are high net worth individuals, over 30% of them were bearish. So it's interesting to see how the people you're listening to, the people you see on CNBC or read about in the financial press, can influence your attitudes. But here we have a much more balanced view, and I think this is more typical of what we see as we go around and talk to advisors. So let's take a look at the market and see what we're really dealing with. So here's a one-year chart of the SPY. This is the exchange traded fund that mirrors the S&P 500. It's a capitalization weighted index. We are all, or should be, aware of that. So 5 or 6 stocks like Apple, Facebook, Amazon, Netflix, Google, Microsoft have been driving the index to new highs. They have an outsized impact on the price action of the S&P 500. Always have, always will. Previous years, ExxonMobil, IBM, and so forth. But right now, it's these 6 big cap tech stocks that are driving it. So what are the key takeaways from this chart? Well, number one, we've been banging up against our upper volatility bands in the 2480 area, and we're banging up against the upper channel here. So accompanying all this is very strong Chaikin Money Flow. Why is that important? Because Chaikin Money Flow looks back over 21 trading days and gives you an accurate view of what institutional investors are doing to get equity exposure, because both individuals, but primarily institutions, use the SPY to get instant equity exposure using the S&P 500 as their preferred benchmark. And so we can see from these big mounds of green in Chaikin Money Flow, which typically fluctuates around a zero line and gets red on corrections, that even on these pullbacks, institutions are buying the pullbacks. So if everything's rosy, second quarter earnings came through beautifully, guidance was great, Why is the S&P 500 having trouble getting through that 2475, 2500 area? Well, here on the second chart is what I believe is the answer. This is a chart of the Guggenheim equal weighted S&P. Symbol is RSP. So every stock in the SP 500 has the same weighting. Notice that whereas the SPY was banging up against its upper band, the RSP has been correcting down to that center line, which is the 21-day average. And then if you look at our proprietary relative strength indicator, it's not green the way it was subsequent to the presidential election through February. It's red. Now, what does that mean? It means that the average stock in the S&P 500 is underperforming the index, which means that the large cap stocks, those 6 FANG stocks plus Microsoft, are doing the heavy lifting. In an environment like that, it's very difficult for the market to break out on the upside, which is why we're in a narrow trading range. Fundamentals are good. Second quarter earnings were great. Guidance suggests that third and fourth quarter earnings are good, but it's only a few stocks that are carrying the market. So we're sort of in a tug of war between the need to get more stocks participating and the fact that fundamentals are very strong. So with that in mind, namely that we're bullish based on the longer term trends, but running up into shorter term resistance, we're going to try and focus the webinar on some of the things that you can do as financial advisors to manage your client portfolios and expectations in this next 4 to 8 week period. And before we get to that, I'd like to put up one more poll to see if you actually use options in any way to manage client portfolios. So Joe, you're on again.
All right, so as Mark just put it, do you use options to either generate income, hedge client portfolios, or neither? And it looks like just about half of the audience has responded already, which is great. A little sneak peek, I can see some of the results coming through, and it seems pretty well one-sided. We'll give you about 5 more seconds because I see there's still a few more responses coming through. All right, and I think we're just about there. And here are the results. Mark?
So 60%, 67% not using options, 20% to generate income, 13% to hedge client portfolios. Well, that is an interesting result. We've not asked this question before of the advisor community. So if you're interested in how you can protect a client portfolio, as we're heading into this period where the market typically peaks after second quarter earnings season as market participants head off to the beach. And we've got a vacuum with Congress in recess and so forth this year. We've got the president on an 18-day golfing vacation. What can you do to protect client portfolios if we did get that first 5% or 6% correction that we haven't seen now since Brexit in June of 2016? Well, there's a very simple way that you can use put options, in this case a vertical put spread, to protect a client portfolio, and I thought I'd illustrate that here. If you think that the market may be vulnerable to a correction in the September-October time framework, and any of you have been in the business for more than 6 years know that that's the period when we normally see that type of a movement, sometimes a lot more than 6%, you could buy the October SPY 248 put, and against that sell the 240 put. And these expire on October 20th. So they give you more than 2.5 months of protection. And they protect you or your client from an 8-point drop in the S&P from this 208 level, which is about 3.5%. And the cost of doing that is only $217 per $24,000 worth of a portfolio, which is very, very cheap. You've been reading how volatility and the VIX index are very low historically. Well, that enables you to buy protection for a client portfolio or speculate on the downside and try and make some profits. But the bottom line is this has a very good risk-reward ratio. This strategy would go up 300% as a speculative strategy if the market drops just 3.5% between now and October 20th. And of course, along the way, there are chances to pick up profits. So just an example, we have an options play idea module that we license built into Chaikin Analytics, so you can generate strategies like this almost instantaneously. But as you see from this current slide, we're very focused on the concept of information overload. As we talk to advisors, as we talk to individuals who are managing their portfolios or monitoring their advisors, there's a common theme, and that theme is pretty clear. There's just too much information to process.
Yeah, Mark, there's a tremendous amount of information overload. Over the years that I managed money, I can't tell you how many analyst research reports I've read, whether it's my own analyst work, Wall Street research. I've looked at spreadsheets, I've analyzed data, and I can tell you that there's no doubt in my mind that the Chaikin Power Gauge cuts through the clutter and identifies stocks that are poised for outperformance. The Power Gauge does the work for you. It looks through financials, earnings, technicals, and expert opinions to help you identify names for your portfolio. So I think this is really an exciting time for people to be looking at a tool given the information overload that's out there.
So this could have been a picture of you 20 years ago sitting next to Marty Zweig.
Yeah, I'm not sure if it was Marty with the paper or me with the paper, but I'm not sure who's in what seat. But the dying plant behind it kind of tells the story of how much time we spent doing other things like research reports.
There you go. Well, our solution for the information overload problem is Chaikin Analytics. And why don't we dive right in and show you what Chaikin Analytics is all about. But before that, a lot of validation. It's important to understand that there are a lot of services out there, you know that, models galore, but we've been fortunate to not only get back some of our old institutional clients like Soros Hedge Fund and Fidelity Investments, but also Paulson, but then be recognized by people like Forbes and Barron's and Benzinga, CNBC, where we were quoted today, and John Malden at Malden Economics, who I know has a very big following in the advisor community. So we've been used by the pros and quoted in the media. And part of the reason is that Chaikin Analytics, in the course of the 7 years that we've been live with products for advisors, has helped improve returns. And we do that by giving you a directional edge. We do that by combining fundamentals with technicals, combining that into a multi-factor quantitative model, and then providing buy and sell signals to better aid what we call low-risk entry and exit points. Now, I mentioned that when I ran the options department at Tucker Anthony, 95% of options traders lost money. And the reason is they didn't understand the importance of a directional edge. Now, if you're a long-term investor managing client portfolios, you still need a sense of the directional edge, and we're going to show you why on the next slide, because there are many opportunities in the marketplace, and knowing which ones are likely to result in profitable outcomes and which ones are more dicey is really critical. So we've encapsulated the whole Chaikin methodology into this pyramid. At the top of the pyramid is what we're going to be talking about today, the Chaikin Power Gauge rating, which is our go-to fundamental indicator, and industry group and sector strength, not based on price performance, but based on the power gauge rating for the individual constituents within that industry group or sector. At the bottom of the pyramid is where we bring technical analysis back into the picture. We look at just two technical indicators, Chaikin Money Flow and Chaikin Relative Strength, and we think that's so critical, and we'll show you how to use it and why it's important. And then in the middle, Chaikin Buy and Sell signals. If you're a more active manager, they become really critical. If you're a longer time framework investor, they're still helpful at determining when to allocate money to a particular stock.
It's a great point to figure out when to enter a stock. Even if you're a long-term investor, I tend to have a longer-term time horizon myself. And I think what's great about this slide is it really does convey that every great money manager has a discipline and sticks to it. You need to have a plan. Every advisor needs to have a plan for each client. So it's great that we start off here by delivering the message that to build a portfolio for yourself, for your clients, whoever, you need a disciplined approach.
Well, let's look at two very disciplined approaches. One we call classic Chaikin bulls. The Chaikin Power Gauge rating needs to be bullish, and you'll see how we output that. That means that the fundamental factors are lined up favorably for the stock. We believe that if a stock is outperforming the market and the Power Gauge rating is bullish, that you've got a very powerful combination working for you. And then finally, Chaikin Money Flow should be strong, indicating that institutional investors are accumulating the stock. Just like we saw with the SPY, even on the pullbacks, money flow stayed green instead of going red. That tells me that the institutional investors are accumulating stocks on weakness. So here's our poster child for the classic Chaikin bull. We've been using it for about 6 or 7 months since December, January. I think we're going to have to retire it because the technology stocks have undergone some profit taking and the power gauge rating has now gone neutral. But at the bottom of this 1-year chart of AMAT, Applied Materials, you see the power gauge is a ribbon that goes from red to yellow to green. And as you can see, for the last 12 months, the power gauge rating, the fundamentals on AMAT have been very favorable. Right above that is our unique way to portray relative price performance. We output it as a heat map that goes from red to green, and you can easily see that AMAT has been outperforming the S&P for the last 12 months and beyond. You could go to William O'Neill and get his relative strength, which also looks back roughly over 6 months, as we do. But then you're getting a number from 1 to 99. And to me, numbers contribute to information overload. I love to look at a picture that conveys a lot of important information. And then if you jump to the Chaikin Money Flow, you see that for the past 7 months, since January, institutions have been accumulating AMAT. And part of the reason is up here on the price chart. We label each of the 4 previous quarterly earnings reports with an icon EPS, and then we color that red, gray, or green. In this case, AMAT has had a series of positive earnings surprises. It's one of the things I learned from George Douglas, that earnings surprises come in bunches. There's never just one of them. And then finally, you see an example of our buy and sell signals. In this case, we call this a relative strength buy. It's great for entering a position knowing that the odds favor 4 to 8 weeks of upside price movement. The market can always submarine that, but in general, this signal has worked with 70% accuracy over 4 to 8 week time horizon. So it's a great way to get into a stock or add to a position.
And that was one of the things that I used, was a relative strength buy, Mark, when I designed a lot of my own portfolio, when I reconstructed everything that I had using Chaikin Analytics in my own portfolios. And I think each of these cases shows it was a very good entry point.
Well, the key here is that it's discipline. So the Chaikin relative strength indicator lies at the heart of this. And all these signals are explained on our website. Whether you're a subscriber or just a visitor, you can go and see the underlying premise. And this one's so simple. A stock that's been outperforming the market dips down under its 21-day average, gets oversold, and then rises back above it. When it rises back above it, it's basically saying that particular short-term selling is over, and now you can comfortably get back in. And as I said, it's worked 70% of the time. It's also best if the power gauge rating is bullish, but sometimes you'll see a buy signal like this in a stock like Tesla or Amazon, where there is no fundamental support for the underlying price of the stock to speak of, particularly in the case of Tesla with burning cash. So knowing that there's a disciplined way to find stocks or define what represents a classic Chaikin bull, how do you find them? Well, in Chaikin Analytics, we have a screener. And in this case, I took a screen from a webinar that I did about a month ago, where I started with the Russell 3000, required that the power gauge rating be very bullish, and then looked at one of the 20 factors in the model, which we're going to go into in a minute, earnings surprise. I love stocks that are reporting a history of positive earnings surprises. Our earnings surprise factor looks back over 5 quarters and weights the front quarters more heavily. So If a stock has a strong earnings surprise factor, it means that there's been a history of positive earnings surprises. And then I took our two technical indicators, money flow and relative strength, required that they be strong over the last 3 months. And finally, just wanted to look at large and mid-cap stocks. So I narrowed the Russell 3000 down to 17 stocks. If you're an active stock picker who builds bottom-up portfolios, this is a fabulous tool. And in the month since I drew this screen for a prior webinar, Allstate has moved up to new highs, as has Anthem Health. Activision Blizzard, same thing. KB Homes has been very strong. So there's been persistency even in this 4-week period, which the screening process identified.
And as you know, Mark, this is how I originally sat down and built my own and reconstructed my own portfolio using Chaikin Analytics. The other thing that I'd highlight is at the very bottom under fundamentals on the left, you can see earnings date. And I think that, given how volatile this earnings season has been, maybe there are some people that say, hey, I'd like to screen for stocks that have already reported earnings, and you can do that. Or you can say, I want to take a gamble here and find a very bullish stock in Chaikin Analytics that is due to report and maybe get a little bump on the way up. So there's a powerful tool here that can be both used for long-term investors that are building portfolios, or even short-term traders that want to find a name that might be poised for a nice jump.
And we're going to see a couple of good examples of that toward the end of the webinar. So if there are classic Chaikin bulls, you would expect there to be classic Chaikin bears. And fortunately, you're just doing a 180-degree U-turn. Power gauge ratings bearish, meaning the fundamentals are negative, stocks underperforming the market. And Chaikin Money Flow is red, not green, telling you that the institutions are selling the stock, not accumulating it. And for the last year, our poster child has been Under Armour. Prior to that, it was Chipotle. Prior to that, it was Kinder Morgan. Prior to that, it was Wynn Resorts. But the interesting thing is we've used Under Armour now for over 8 months, maybe 10 months as our poster child for the classic Chaikin bear. And the reason is that the power gauge rating at the bottom, that red, green, yellow ribbon, has been bearish since August of 2016. The stock has been underperforming the market the whole way, and in the major selling that saw the stock bottom out at 18, down from 42, institutions sold every opportunity they could. Now, this was, as you know, a stock that was a darling of the hedge funds and the fast money crowd. They were trying to compete with Nike in the footwear business, with Lululemon in the performance clothing business. And guess what? Adidas is out there eating their lunch. Nobody was watching Adidas, but suddenly Adidas has come up and hurt both Under Armour and Nike, as well as other apparel stocks who are in this space. But the key is, number one, the power gauge rating was your go-to guide. Confirmed by relative strength, that means the market agrees with the model. Carlton's old associate, Marty Zweig, used to say, you can beat the market very simply by just doing 2 things: watch the Fed and listen to the market.
Yeah, he used to also say the trend is your friend, and that's your version of the market agrees with the model. The trend is your friend here, and in this case, it would be your foe if you're long the stock. If you're short it, obviously, it'd be your friend. But look at how long that chart has persisted with the directional edge of the power gauge.
And even after the institutions came into the stock, maybe this money flow bump was short covering, could have been in response to that earnings report. You've had 2 earnings reports since the stock bottomed out, but notice that the institutions were still waiting to sell the stock. So the spike up after earnings has really been the sort of end of the rally, and then you get further pullbacks. So the bottom line is, if you're inclined to bottom fish or believe some of the people on CNBC or the news stories that tell you that Under Armour is oversold and it's a value now, don't believe it. Wait till you get some confirmation from the technicals, or for the model to turn neutral, the analysts would really have to start warming up to it, and they're not doing it yet. So the power gauge rating has been reliable in the 6 years since we released the first product based on the power gauge rating, January of 2011. we output it as a gauge in almost all of our products. It's the centerpiece of everything we do at Chaikin Analytics, from analytics terminals to research reports to investable products. They're all based on this simple but powerful 20-factor model. But just because the gauge is simple, don't think that the model is simplistic. It's very powerful. At this point, when my wife does a webinar, because she's learned the system from scratch and in the last 4 years has beaten the market every year with a mix of both large and small cap stocks that she finds with the screener and uses this very simple methodology, she puts an iceberg up here. What I prefer to say is that the power gauge is like a Chevrolet with a Ferrari engine under the hood. There's a lot going on under the surface. And it can be your GPS during earnings season. So what's in the Chaikin Power Gauge rating? Well, we have 4 primary factors: financials, earnings, technicals, and expert opinions. And within each of those 4 primary factors, we have 5 sub-factors. 20 factors in all. It's a multi-factor model. They've become very popular recently. And it covers really the 4 categories that Morningstar uses to group stocks: value, growth, momentum, and sentiment. It's what any good strategist at Merrill Lynch or Morgan Stanley would look at before making a market overview call. So the financial metrics are 35% of the model. Fundamentals are 85% in total. Technicals are only 15% of the model. And the earnings factors are what you would expect: earnings growth and so forth. But I've boxed in red earnings surprise because, as I said in the beginning, a lot of what I learned from mentors along the way on Wall Street is incorporated into this model. And that's part of the reason that it works. It's not a theoretical quant model built by some newly minted PhD at MIT throwing digital spaghetti on the wall to see what sticks. That's what got us long-term capital management drop in 1998 and the financial collapse of '08. This is a model that works because it's based on the way Wall Street works. These are the factors that successful institutional investors, active managers look at every day. This is what I learned selling my technical analysis workstation to value-oriented, growth-oriented investors. I had to learn what they looked at. So one anecdote I'd like to share with you: George Douglas, when I was at Drexel in the mid-'80s, did the seminal research in earnings surprise and earnings estimate revision. And George taught me 2 things. Number one, earnings surprises come in bunches. There's never just one of them. We saw that right now with AMAT and then on the downside in Under Armour. But almost as important, he taught me that earnings surprises lead to analyst estimate revisions. It sort of makes sense, but this is a trend that's been going on for over 40 years. George did the research in the mid-'80s. And to this day, particularly in the small cap space, when a company reports a positive earnings surprise, analysts tend to raise their estimates. But this information seeps into the marketplace slowly over time. Carlton, any thoughts on earnings surprise?
Well, what I was going to comment on is that while you look at the fundamental factors in the model, you say, oh, wow, there are no macroeconomic things like interest rates. And, of course, interest rates matter for sure. They matter because they're tied to the economy. And if the economy is good, that's probably good for earnings. Ultimately, earnings drive stock prices. And the great thing about the power gauge is that it has earnings growth, earnings surprise, and other fundamental data that are in the model to pick the best stocks. So certainly earnings surprises ultimately increase earning estimate trend, which probably helps stocks grow and ultimately, puts people in the right stocks through the power gauge.
Well, I think this is important because earnings estimate trends are the single biggest driver of short-term price movements. That's been documented in academic research. So what you have here in the model is a combination of longer-term value metrics, which are the financials, price to cash flow and price to sales, very important to people like Seth Klarman, Warren Buffett, Graham and Dodd, Bob Arnott. All the successful value investors use that, but then we've blended them in this eclectic mix with shorter term factors, so the model is sensitive enough to pick up on changes in thinking regarding macro factors like interest rates and so forth.
And you saw yesterday, Mark, the article in the Wall Street Journal about how value investing is dead. And that's exactly usually the time that things like that turn around, the death of equities. So in this case, here's a multi-factor model, 20 individual factors built around 4 primary factors, including financials and earnings, which are roughly, as you suggest, value and growth. So you get both that will be able to identify stocks that are poised for outperformance.
And then finally, industry group relative strength is one of the factors in the model, and we're going to look at that now as we move forward in the webinar. So just a couple of more slides on performance, validating what James O'Shaughnessy, who's written 2 very, very successful books on factor investing and what drives stock prices, and is now managing money with his son. Models beat humans. Models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by emotions and opinions. Well, when you look at the performance of the Power Gauge rating in 2016, using the Russell 3000 as a universe, the very, very bullish stocks in the Russell 3000 in 2016 up 32%. Very bearish stocks up only 9.5%. And each of these silos is equally populated. So we're not just taking the tails of the curve. So if you have a choice between a very bearish stock like Under Armour, a very bullish stock like AMAT or Anthem Health, this performance table should convince you that you want to focus on the very bullish stocks. Even if you're a value investor, you can find value in very bullish stocks. Now in 2015, the point was driven home much more dramatically because small cap stocks and energy stocks were in a bear market in 2015, and this performance graph shows you that. The very bearish stocks, using the Chaikin Power Gauge rating, down 17% in 2015. Very bullish stocks down only 1%, roughly equal to the market. This spread is what you're trying to capture. On the upside, you want to make sure you're in the very bullish or bullish stocks, and on the downside, you want to avoid the very bearish stocks. So one final proof point. We've partnered with 2 very strong financial institutions, Nasdaq and New York Life Insurance and their mainstay IndexIQ subsidiary. With Nasdaq in 2014, we created 3 co-branded Nasdaq Chaikin Indexes: large cap, small cap, and dividend achiever. The idea was to build a track record. We've built a 3-year track record on these indexes, which are rebalanced just once a year. So if there's a question in your mind, well, this all looks great so far, but I think it's probably for shorter term traders or investors, the Nasdaq Chaikin Indexes are annually rebalanced on April 1st. And we did build up a very, very strong 3-year track record, as you'll see, going through 3 rebalances or reconstitutions. And because of that, New York Life's IndexIQ subsidiary has licensed all 3 of these indexes, registered them with the SEC, with the idea of rolling out exchange-traded funds based on them. And this is the performance that got New York Life so excited. Carlton, why don't you run through this and talk about what we've been doing for the last 2 months?
Absolutely. So what is remarkable, as you mentioned, and I think it bears really highlighting, is this is an annual rebalance. So these are a 3-year track record with NASDAQ, utilizing the NASDAQ benchmark of large cap, small cap, and their dividend achiever, and then overlaying the Chaikin Power Gauge and finding the best stocks within the master index to create 3 NASDAQ Chaikin indices, one on the large, one on the small, one on the dividend. And you can see the vast excess return on the right that's been generated over that 3-year period. And this, as you mentioned, is not cherry picked. There were only 3 indexes created, and the Chaikin Power Gauge was the primary driver of the performance. 612 excess return for the 3 years in the large cap, 2,127, so virtually doubling the Russell 2000 in that period, and over 2100, basically doubling the Nasdaq benchmark in the small cap. And then similar for the dividend achiever, you can see 1647 basis points of performance. And as you said, this is what got IndexIQ, mainstay New York Life, very excited. And since you and I have been traveling on the road talking about these indexes that are used as the basis for the ETFs that are rolling out, we've met with a lot of advisors. And it's really struck me that the tools available to advisors to really differentiate their practices has diminished. We've got many firms that have been cutting back on research. The internet has many clients thinking they can do more themselves. You talked about Robo-Advisors earlier. And on top of that, you have sort of more and more passive money management strategies out there that are basically indexing. So ultimately, I think that one of the strengths of the Chaikin Analytics platform that can help advisors use the tool to really engage their clients is a way to promote their own ability to kind of scan the landscape of appropriate investments, you know, whether it's stocks or ETFs, and ultimately build a better relationship with their clients as advisors.
And again, the reason that we start out by stressing the performance metrics is we want you to come away from this webinar believing that there are tools out there that can help you better grow your practice. By integrating them into your daily routine, you can have more meaningful conversations with your clients, analyze their portfolios periodically for client meetings, but B, free up your time to prospect and bring in new business, because as we said, information overload is our biggest enemy and time is our most precious commodity. The Power Gauge rating does the fundamental heavy lifting for you. The proof is in the excess returns of the indexes, and the Nasdaq index, which is the basis for the IQ Chaikin small cap ETF, symbol CSML. This is not meant to be a recommendation to buy it, just validation, has garnered over $150 million in assets in the 2+ months that it's been in existence. It's the most successful multi-factor ETF launch of 2017, and we're very proud of that. But the same ideas for stock selection that we're talking about here on a bottom-up point of view are being used in a top-down methodology to create these indexes that underlie the first ETF that's been launched. So let's go through two very simple but powerful concepts, and then we're going to start talking about exchange-traded funds and how you can use Chaikin to identify the best sectors and industry groups and then the best stocks within those ETFs. So we have a concept that we call personality changes. And I believe that spotting personality changes is really the key to making and keeping profits in the stock market. And the reason I say that is that too often we put our feet in cement. We fall in love with stocks, or we love to hate them, as I love to hate Tesla, but I try not to let that impact any subjective judgments. I go with the model, which is bearish right now, was bearish, is neutral right now. But putting your feet in cement in the stock market is absolutely fatal. So here are two examples of personality change. In the case of Anthem Health, we're looking at a bullish personality change. Anthem was underperforming the market prior to the presidential election outcome, and we can see that because the relative strength indicator was red and the power gauge was neutral. Shortly before the election, the power gauge turned bullish, and then as the stock broke out with the unexpected victory of Donald Trump, the relative strength to the market turned green, and we now had what we call our dynamic duo, relative strength and the power gauge rating, fundamentals and technicals, both positive. And then you look up at the money flow and you see that the institutions started to accumulate aggressively these healthcare stocks.
And what's also interesting, Mark, is you can see while it took a pause there shortly after the election in the new year, there was an oversold buy recommendation that of which you could, you know, in the system, when people use it, they can click and see what the buy signals are. But that was an incredibly powerful entry point for that stock.
And this is sort of typical of what happens with a bullish personality change. When you get relative strength to the market and fundamentals in gear, you can get acceleration to the upside. So even with all the uncertainties about healthcare and where the Affordable Care Act is going, whether it be repealed, replaced, or untouched, Anthem Health has gone from 130 all the way to 195. And the power gauge and the relative strength, the money flow have supported that move all the way up. And you've had a string of positive earnings surprises, including one just 2 weeks ago, where the stock actually sold down on the news and then the buyers came back in. So personality changes on the downside are even more important because they can keep you out of trouble. So here's Hertz Global having a very tough time of it in the rental car and used car business, along with Avis, and as we'll see in a minute, along with auto parts retailers. But the power gauge rating was bearish on Hertz back here in the 35 area in October of 16. Money flow was negative. And then you had a bearish personality change. Now it came after a negative earnings surprise. Can you see that on the chart? There's your EPS. So the stock spiked down all the way to 15 and then rallied back to 24.
That was definitely a short cover rally right there, Mark.
Yeah, that's the shorts who were in the right place at the right time, taking their profits. But if you were still long Hertz in a portfolio, or if you had a research report in front of you that said now's a great time to establish a position, the discipline of the power gauge rating and Chaikin relative strength would have signaled a red flag of caution to say not so fast. And along the way, you had some sell signals, in this case, our relative strength sell signals. They came at 18 to 20, and you might say, well, 20 down from 50, that's too late to sell a stock. And I really believe differently. It's never too late to sell a stock where everything's lined up against it. And the ultimate low on Hertz was about $9. You've had a nice rally here with some money flow kicking in as value investors are coming into the stock, but it still has trouble holding on to those gains. And when I pulled this chart earlier today, down 1.5%, no guarantee that the bottom's been seen, but guessing doesn't work on Wall Street. You want to be sure and have everything lined up in your favor. Now, the second concept that I want to impart to you is something we call the secret sell signal that 95% of investors never see. It's a Chaikin bearish money flow sell alert. And it works because institutions like to cover their tracks and sell when other people are buying if they can, liquidate a position. So here's an example, because we're going to look at the auto parts retailers in a minute. It was a weak industry group, but everything was looking pretty good except for the fundamentals. The stock had strong relative strength, so it was a momentum stock here based on a positive earnings surprise last November. It spiked up to a new high. Money flow was green. Everything was fine. But then notice what happens right in here when it makes a nominal new high near our upper volatility band, and then go down and see what money flow was doing. Money flow was red, not green. This is a very, very negative pattern. We've been teaching it to institutional investors and traders for over 30 years. Money flow should turn green when a stock is making a new high. If it doesn't, it tells you the institutions are selling the stock under cover of strength. Could be short covering, could be unsophisticated buying, could be the public reacting to a news story, but the big institutions are selling the stock. So you could have sold Advanced Auto Parts at 170. But if you didn't, you can see that when the stock has the power gauge turn bearish, and it's underperforming the market, that you want to be out of it, because the institutions are going to continue selling the stock all the way down. And look what we had here, an oversold, an overbought sell signal based on a new 8-day high and a bearish power gauge stock right ahead of that earnings report 3 months ago, which saw the stocks gap down on a negative earnings surprise. Following this methodology, you could have been out of the stock, protected clients' holdings with put positions if their tax cost was so low that you couldn't sell it, or benefiting on the downside in speculative accounts. But the bottom line is that money flow sell alert came at 170. The rest of this selling activity is in the 140 area, and the stock ultimately bottomed out at 100. Now, the reverse of this is when institutions are continuously accumulating a stock. We saw it in AMAT. We'll see it in another few examples here. We saw it in Anthem Health. When you have persistent accumulation and a stock gets oversold but money flow stays positive, that's a wonderful entry point. It's telling you that you're buying with the big institutions instead of bucking that trend. And in this example here, KB Homes, which is benefiting by a renewed interest in first home buyers, that's the market they cater to. You got an original buy signal down here in February. As I was doing a webinar, we pointed this out. The stock was 16 on the way to 24. And along the way, you've had persistent accumulation. In this week's version of Market Insights, which is my weekly newsletter that comes bundled with Chaikin Analytics, I made DR Horton my bullish stock of the week, also in the single family first home buyer market. Very attractive money flow, as strong as it has been in KB Homes, or stronger, positive earnings surprise. So the group trends do matter. Now, speaking of group trends, let's look at how you can use sectors and industry groups and the associated ETFs to help allocate client assets. We're first going to show you what we call our power bars for institutions, because even though it's been well documented that ETF sector and group strength or weakness puts the wind at your back if you're on the long side in a strong sector or industry group, most of the analysis on industry groups has been done based on price action, price momentum. We have a unique way of determining which sectors and industry groups have the best potential because the Power Gauge rating measures potential. So what we do, starting with a top-down look at the 10 Select Spider sector ETFs, these are the S&P 500 stocks carved up into 10 sectors, and there are ETFs representing each of them. A lot of liquidity. A lot of advisors allocate client assets to these ETFs. A lot of high net worth individuals use them to get exposure to financials or technology if they don't want to pick individual stocks. But our way of ranking these is called the Chaiken Power Bar, and that's what you're looking at on the screen. How many stocks in a particular sector ETF have bullish versus bearish Power Gauge ratings? Right now, there are only 4 sectors: utilities, financials, healthcare, and technology, that have positive power bars, meaning more bullish than bearish rated stocks, more stocks with bullish potential than bearish, than the S&P itself. Now, right at the bottom, where it's been for the last 6 months since February, is the Select Spider Sector Energy ETF, the XLE, which has no bullish rated stocks, and real estate with only 1, and then consumer staples. So it's very easy, if you believe in the Power Gauge as a predictor of future price movement, to find the sectors that are likely to outperform the market. Now, industry groups are more granular than sectors. So within the industrial ETF XLI, you've got aerospace and defense, which is right at the top of the list with 18 bullish and no bearish. And you also have it within the top 15 out of 67 industry groups, apparel, which is a turnaround. Apparel had been near the bottom of the basket 5 or 6 months ago. It's now seen a turnaround. So let's look at a couple of stocks in the apparel and aerospace group to see how this all plays out. So on July 9th, just 1 month ago, in my weekly market insights, and that should be Sunday, July 9th, not Tuesday, because the market letter is written on Sunday, I identified 4 bullish apparel stocks that were either turning the corner or on their way. I mentioned that the apparel stocks had been weak. So we zeroed in on the fact that they had peaked in November, just after the Trump victory on fears of border taxes or a trade war that might negatively impact the group. But in Barron's that weekend, there was a story about a bullish turnaround in the group. So I used our stock screener to find 4 apparel stocks with bullish power gauge ratings to buy on pullbacks of 1.5 to 3 days. Let's look at how 2 of them, Michael Kors and PVH, did. As a group, these stocks have been up 7.5% with the S&P up 2.5%. But PVH, which went sideways after that recommendation with the stock around 112, has gone up to 124, so a nice 11% move. Notice you had a bullish personality change ahead of that after a long period of underperformance and a bullish power gauge rating. And then Michael Kors, which hadn't yet really broken out to the upside when I made that recommendation, you can see where it was at the time, did give you that pullback of 1.5 to 3 days, then started moving up. Relative strength hasn't even turned bullish yet. Look what happened this morning. Michael Kors reported better than expected earnings. The stock spiked up 17.5%. When I last looked, it was up 21.5%. That shows you the innate ability of the power gauge rating to anticipate future price movement and help you position client portfolios ahead of positive earnings surprises. So this is a chart of the sector performance over the last 3 months, and it highlights the potential that the power gauge is showing for the fundamentals: financials, healthcare, technology, and utilities. Best performance, they're also the stocks with the best power bars, and right at the bottom, energy, which is down 4% with no bullish stocks. Now, as I said in the beginning, playing good defense is really critical to protecting client assets, but also to making money and avoiding problems. And I love a quote from Herb Greenberg, who took a hiatus from Street.com and CNBC, but is now back for 2.5 years after writing this column where the headline was, "It's the stocks you don't own that matter." Herb went off to do short sale research for hedge funds, but he's now back on CNBC. And what did he mean by that? What he meant was that you can reduce risk by reducing and avoiding mistakes. One of the ways you do that is by avoiding weak industry groups. Another way is to know what stocks not to buy. Don't buy the Under Armours of the world. Don't buy the Hertzes of the world. And Herb said that you can improve performance by eliminating potential losers from your portfolio. And then I add that you can use put options to protect your portfolio. So playing good defense is really important. We've been in an 8.5-year bull market, so we're not quite sure when the next correction or bear market is coming, but you always have to keep an eye on defense. Now, here's what a bear market looks like. This chart was developed by Richard Wyckoff over 90 years ago. It was his idealized way of describing the way stocks go up, and in this case down, from a distribution phase to a breakdown, and then the various corrective waves in between. So we've often been asked, what can Chaikin Analytics do for me in a bear market? And since March of 09 rather, we've been in an 8.5-year bull market. Well, in the midst of that bull market, energy went into a bear market. This is the XLE, the Select Spider Sector Energy ETF. These are all the large cap energy stocks in the S&P 500, and it peaked in July of 2014. You had a bearish personality change in late August, and the XLE dropped from 100 all the way down to 50. Energy was in its own bear market. Small cap energy stocks did even worse. So when you're in a sector that has bearish power bars and bearish technicals with the relative strength weak, you're looking for stocks to short, to avoid, to get out of, and there were a whole host of stocks starting in January of 14, actually, the offshore drillers, then the fracking stocks like Range Resources and Pioneer, the big names like Schlumberger, Halliburton, Helmerich & Payne were weak. Kinder Morgan held up because of a big dividend and some roll-ups. I call that financial engineering of their MLPs into the master company. So it held up until early 2015, but when it gave up the ghost, you got a bearish personality change and the stock dropped from 42 all the way down to 10, dropping not 50%, but more than 75%. And along the way, this is what Kinder Morgan looked like. This is a one-year chart. That was a 5-year chart of Kinder Morgan. Here's a one-year chart. Power Gauge rating turned bearish in March 2015. Stock was $40, a huge dividend. A lot of sophisticated investors thought the dividend would be maintained. It was cut. You got a bearish personality change, institutions selling it. Along the way, if you didn't get out there, you had the chance to get out above 30. And again, it's never too late to sell a stock where everything's lined up against it, because the stock ultimately bottomed out in the $12 area.
Key point is trying to avoid the losers, or if you do have a loser, recognize it's a losing position and cut your losses further. That's the name of the game, is really finding winners in different market environments and trying to avoid the losers and recognizing which stocks in your portfolio are poised for underperformance and get out of those.
And that's really the key. It's, again, going back to Herb Greenberg, it's the stocks you don't own that matter. If you can just avoid one loss, like a Sun Edison or a Kinder Morgan in a client's portfolio, imagine what that can do for the bottom line at the end of the year, psychologically as well.
I know you've mentioned a few times, Mark, that Warren Buffett has that famous quote that on Wall Street they don't call balls and strikes. You can wait for your own pitch. One of the great things about using the tool is that you can find the names that you like and the names that look good in the analytic tool, the very bullish and bullish stocks, and pick your pitches and find those names. I think you mentioned Herb Greenberg. York Capital's founder, Jamie Dimon, was on Squawk Box this morning. Maybe many of the advisors saw him on the program, and he even mentioned that, you know, sometimes just sitting on your hands and not doing something is the right thing to do. You can pick your pitches, you can find the names that you like, and you can utilize the tool to do that.
Well, sage advice from a portfolio manager who was in the trenches. So let's look at energy now. Here's the XLE on a one-year chart ending today. And you can see that we had a bearish personality change in January with the XLE at around 73. Ultimately, it bottomed out at 63.50. So you had a 15% drop in the XLE while the stock market was going to new all-time highs, and money flow coming out of this large cap energy ETF. So when you see that pattern develop, you're going to look for stocks like Schlumberger, fabulous name, but terrible performer this year, which 2 months after that personality change had its own personality change, and then right ahead of an earnings report gave an overbought sell signal up in the 77 range. Bearish earnings surprise, stock drops to 69. Another sell signal, bottoms out ultimately at 64, but still having trouble gaining traction on the upside. Or you can look for a stock like Pioneer Natural Resources, a fracking stock involved in the Permian Basin. You had had one sell signal up here at 170, stock dropped to 155, and then it rallied to 164. Ahead of earnings, gave another sell signal, and negative earnings surprise saw the stock drop from 161 all the way to 130. You can avoid disasters like this in client portfolios, avoid bottom fishing, and skew your portfolios in the right direction. And if you're allocating assets to ETFs that have a heavy position in a stock like this or similar stocks, and we're going to show you at the end of the webinar the new innovation at Chaikin Analytics and help you find similar stocks to a Pioneer, so you can know where to avoid and find ETFs that might be giving you exposure to stocks that you don't want to be in. So one final idea about defense, we have something in Chaikin Analytics that we call our power grid. In fact, we're moving the whole portfolio health check where Chaikin Analytics puts the power grid to the front and center on our desktop app. And I call the power grid your defensive coordinator. You can put any client portfolio, ETF, or list into Chaikin Portfolio Health Check, and one of the pieces you get back is this power grid, and the interpretation is really clean and simple. On the bottom left are stocks with bearish power gauge ratings in industry groups with bearish power gauge ratings. So you want to avoid them. And in the upper right are stocks with bullish power gauge ratings in industry groups with bullish power gauge ratings. Now this chart was done for our documentation probably 4 years ago. Notice Schlumberger was in there along with Line, which I think went out of business, and Royal Gold. And in the upper right, you had Allstate, which is making new highs, Lincoln National, Symantec. 4 years later, some of the same stocks are in the same position. Some have changed, but some have not. So this power grid can be a very, very simple defensive coordinator to tell you what stocks you need to avoid, where to focus your attention to get a client's portfolio in better shape. So earnings season, real opportunity. A lot of people avoid it because of the volatility. You need some extra information to make decisions during earnings season. You have to know with some degree of reliability whether a stock's likely to meet, beat, or disappoint Wall Street analysts. And we give you that with the Chaikin Power Gauge rating. So here's an example of how I combine industry groups with earnings reports using the Chaikin Power Gauge rating. In my market insights of April 9th, I identified 3 auto parts retailers that had bearish power gauge ratings to sell on strength: Advanced Auto Parts, AutoZone, and O'Reilly Auto. And the reason I said to sell them on strength is they were making new 52-week lows, and I hate to sell a stock at new 52-week lows. I'd like to sell it on a bounce. So my advice was sell these 3-week auto retailers on rallies of 2 to 4% in the short term. Here's what happened. Advanced Auto rallied, gave us an overbought sell signal, had a negative earnings surprise. The stock dropped from 150 all the way to 100. Now, just as with screening for classic bulls, you have to know how to find these. So in our weekly Market Insights newsletter, we have an upcoming earnings section, and we show you not just what stocks are going to report in the coming week, day by day, but whether or not they have a bullish or a bearish power gauge rating. So in a webinar we did on 4/24, I zeroed in on O'Reilly and Helmerich and Payne. Then a month later, I zeroed in on Advanced Auto Parts and Best Buy. We've already seen what happened to Advanced Auto Parts. Here's what happened to O'Reilly. This is April 9th. Stock was 240, rallied up to 260. Negative earnings surprise. The stock dropped from 260 back down to 240, stayed there for a bit. And then here, about 2 months ago, or less, 6 weeks ago, the company, ahead of their earnings report, said same-store sales for June are going to be down 4% year over year. Well, analysts had been estimating a 12% increase in earnings. How in the world can you generate 12% increase in earnings if year over year sales are down 4.4%? Well, Wall Street caught on pretty quickly as the stock dropped from 220 all the way to 170. Ahead of the earnings report, it's now rallied and the power gauge is still bearish. Money flow has barely scratched the surface, so I'm saying don't bottom fish, wait for at least a test of the lows. Helmerich and Payne, negative earnings surprise back in April. Stock dropped from 57 all the way to 49. And then it rallied up, and 3 months later, you had an opportunity to do the exact same thing. With the stock at the upper volatility band, you could have sold it ahead of a bearish earnings surprise, and today the stock's making a new 52-week low. So patterns keep repeating on Wall Street. We actually got this testimonial from an options trader who started subscribing to Chaikin Analytics in January, and he said, I've been trading options for many years, but with not much success. On January 4th, I found your system. I started the year with 235,000. As of today, which was July 30th, my net liquidation is $1,200,000. Wouldn't have been able to do it without your system. Now, Ken H. has learned the Chaikin system. I would not call him a sophisticated investor. Imagine what a system like this and tools like this can do for you, industry professionals who understand the markets and are armed with a new and powerful decision-making tool, the Chaikin Power Gauge rating. So one more look at upcoming earnings reports. This was for a webinar we did a week ago, where Boeing was due to report, as well as Helmerich and Payne again, and you saw what happened there. So Carlton talked earlier about being able to buy stocks ahead of earnings reports. And here's an example of that. Boeing has had a bullish power gauge rating, has been outperforming the market. There's been persistent accumulation. It's in that strong aerospace defense group, which has a power bar at the top of our industry group list, no bearish stocks. The most recent buy signal was a momentum breakout, at which point the stock became hard to buy. But notice what happens when they issued a positive earnings surprise, which shouldn't have been a surprise because the last 4 quarters had also been positive earnings surprises. The stock spiked up from 210 all the way to 240 and beyond. You want to be on the right side of stocks during earnings season. You want to find a way to own a stock like Boeing with a history of earnings surprises, bullish power gauge rating, and outperforming the market to take advantage of these singular events that can add hundreds of basis points to your client portfolio, or if you're an options trader, achieve what we just saw. Ken H. actually bought the Boeing options ahead of that earnings report. Now, I'd like to end the webinar by showing you our most recent innovation, for which we won the Benziga FinTech Award in competition with 19 other companies, some of them these AI stock picking platforms that you're reading so much about. We won the award for Best Ideas Platform in New York in May. And what we won it for was something we call our Stock Discovery Engine. This is a relevance-based discovery engine. It works similar to the way Spotify finds you music, or Netflix finds you films, or Amazon finds you almost everything else in life. It looks at a stock you enter. In this case, on May 25th, I entered Advanced Auto Parts, which we know was bearish. And it immediately came back with 5 other retailers with the same negative characteristics as Advanced Auto Parts. One of them was O'Reilly, which was 240 on the way to 270. Again, it's never too late to sell a stock where everything's lined up against you. But what this discovery engine also does is it gives you potential swap ideas. So if you wanted to stay in the retail space, bricks and mortar retail, even in spite of Amazon taking over the world, there are still successful bricks and mortar retailers. Best Buy was one that I gravitated to, because Best Buy is the poster child for a company that's beaten back the Amazon threat. So just before a webinar that I did back here, Best Buy had triggered an oversold buy signal. Earnings were due out. On the webinar, we suggested a put trade, said to buy this ahead of the earnings, that you had yet another positive earnings surprise, and the stock spiked up from 50 all the way to 61, which was a great place for a shorter-term swing trader to take money off the table, because inevitably you get a pullback from a big move like that. And then we got a second oversold buy signal under 55. The stock rallied up to the upper band, looked like it was going to new highs. And then Amazon came out with an announcement that they were going to create their own version of the Geek Squad. So since everybody is spooked by Amazon, the stock sold off from about 58 all the way down to 53. But now it's regrouped, and guess what? It's making a new all-time high today. So Best Buy is the poster child for how to beat back Amazon, and it's also the poster child for the power gauge rating and relative strength, and our signals to be able to position you in bullish stocks ahead of earnings reports. Now, one final example of the discovery engine. In my weekly market insights, July 23rd, I made Starbucks my bearish stock of the week. It was trading at around 59. And I seeded the discovery engine with Starbucks and immediately saw Chipotle with a very bearish rating trading at 395. And then a potential swap into QSR, which is a company I didn't know, but turns out it's D.R. Horton, the sort of coffee shop company similar to Dunkin' Donuts, and Burger King. So here's what happened. Chipotle dropped over 50 points because sadly the E. coli virus resurfaced. A bearish rating, you had seen that preceded by a bearish personality change. Negative money flow, institutions just don't believe this story. And QSR, which had positive money flow and relative strength, and the power gauge has actually done quite well, especially after another positive earnings surprise. So the discovery engine is one of the most powerful tools to free you up because it can find new ideas. It can find similar stocks on both the long and the short side to stocks that you like, and it can suggest potential swaps. Imagine how much time this can save and how much this adds to your ability to find winning stocks if you're actually constructing portfolios. So now you know our checklist for stocks and ETFs. All the examples we've been showing you come from Chaikin Analytics, which at its heart has a proven stock selection system, the Chaikin Power Gauge rating, that multi-factor model that combines fundamentals and technicals, plus the stock discovery engine for idea generation. And in addition, we've got the screener and our options play ideas module, which you've seen. Chaikin Analytics normally costs $1,950 for an annual subscription. It's less than 1 month of a Bloomberg terminal. Difference is the Bloomberg terminal doesn't come with a proven alpha generating model. So you can go to chaikinanalytics.com/wealth and subscribe to Chaikin Analytics. But as a webinar special, we'd like to reduce the price by $200, bringing it down to $1,750, and this offer expires on Friday at midnight. You can go to chaikinanalytics.com/wealth and take advantage of this offer and get everything you've seen on the webinar at your disposal. Now, in addition, you get our intraday charts, earnings detail and earnings alerts, and my weekly Market Insights newsletter with featured bulls and bears of the week, as we've seen. Plus, as a Chaikin subscriber, you get small group tutorials to help you get set up and learn all the features and benefits of Chaikin Analytics, unlimited coaching and support, plus one-on-one coaching if you need it to customize this to your particular practice, and my colleague John Schlitz's daily morning insights, which means you don't have to stay glued to CNBC before the opening to know what's happened overnight and what's going on in the pre-opening. John Malden, who, as I know many of you follow, got introduced to Chaikin Analytics almost 2 years ago. He's become a partner, and what he said is very important to us. I'm impressed by what Mark has done. My analysts are enthusiastic users of Chaikin Analytics, use it to analyze the trades and recommendations of our team. We've integrated Chaikin Analytics into our routine due diligence for vetting and evaluating potential investments. That's another way that you can use Chaikin Analytics. If you've got firm research, you want to zero in on the best of the best, you're reading Barron's on Sunday, you want to save some time, avoid bullish articles on stocks with bearish ratings. But John tested this against their ideas for the last 3 years and found that it would have enhanced their stock picking. So to make all of this available at as compelling a price as possible, I've got a fast action bonus for you. If you subscribe by midnight tonight, we'll take $300 off the price of Chaikin Analytics for an annual subscription, reducing it to $1,650, plus For the first 10 advisors who call or subscribe today, you'll get a 30-minute one-on-one phone call with me. But to get this, you've got to just subscribe by midnight tonight. So it's chaikinanalytics.com/wealth. Carlton, if you have any final words, a wonderful
I
time
do.
to jump in.
I've seen a lot of things in my career. I've seen a lot of analytic tools. And in my opinion, this is one of the most robust, institutionally friendly systems that I've utilized myself to build portfolios. The Chaikin Power Gauge works. The numbers bear that out. I've really enjoyed using it, and I think after any of the advisors use the system and see how it can help them with their practices in conveying ideas to their clients, in doing their own research, vetting their own analyst reports, they're going to find that, as I have, that it's been a really powerful tool to use for portfolio construction.
And one of the things that we found as Carlton and I have gone around with the mainstay wholesalers from New York Life is that when they're talking about the exchange traded fund, or we're talking about the index on which it's based, the advisors want to see individual stocks on Chaikin Analytics. I have to sort of dampen the conversation down because that's really not what we're there for. But we've sold more systems with people focused on the exchange traded fund and the index that it's based on than we do sometimes on these webinars. So take advantage of this offer, $16.50 for a 1-year subscription, plus if you subscribe by midnight tonight and you're one of the first 10 advisors, you get a 30-minute one-on-one phone call with me. If you want Carlton, I'll twist his arm.
Yeah, that's right. And the support team here is great. I mean, these guys really know the system. I know that some things can look complicated, but the reality is, after just a few clicks, it's very intuitive. You get a very good sense of how to utilize things, and there's always a simple phone call into the team here to know how to use the system even more effectively.
Well, thank you, Carlton. Thanks, everybody, for taking
Mark.
time out of your day, and we'll turn it back to Joe Bacella, who's going to wrap up the webinar.
All right, gentlemen, thank you so much for the presentation this afternoon. Just going to go ahead and pull up the link that Mark mentioned. Again, chaikinanalytics.com/wealth. That is available in your chat room right now. Obviously, we'd like to make that as easy as possible. And I can tell you, having worked with Marc Chaikin for 2.5 years, and obviously Mark for close to at Carlton for about a year now, those one-on-one opportunities are critical. Not only are you going to be able to hear from the wealth of experience that they have, but also, of course, you're going to be able to get a thorough walkthrough with the platform itself. I would love to set you up for that by having you join one of our onboard sessions for newer users. Those, of course, take place 3 times a week, and that's included as part of your subscription. Really, all those extra bonuses that we mentioned, the webinars, the market commentary from Marc Chaikin and John Schlitz, all of that, of course, is included along with your access to Chaikin Analytics. So again, before midnight tonight, we're going to offer this for $16.50 for a full year to Chaikin Analytics. I saw a few people had already requested some demos, so make sure to give us a call. We'll be happy to show you how it works, 877-978-6257, or just simply go to chaikinanalytics.com/wealth. So I hope you enjoyed this presentation. We'll be sending out a recording tomorrow, but in the meantime, be sure to join us. In the meantime, everybody have a wonderful afternoon, and we will see you soon.